Morning, everybody. I'm just getting a few people dialing in. So once my attendees are all here, we'll start. Oh, for goodness sake. Hey, good morning. Can everybody hear me? Yeah, thumbs up.
Yep, loud and clear, Shush.
Excellent, thank you. So, good morning. Thank you for joining us for our forecasting and business planning workshop this morning. Into the new normal. I'll just put my video on actually, so you can see. Not that you really want to, but there we go. That's me. Hello, everybody. Working from home is become the new normal. So, as we say, we are where we are, and we've obviously been sat here in our little rooms, our little offices for about 7 or 8 weeks now. The rumour is that Boris has got some big announcements for us on Sunday, and we'll start to get a feel for how the lockdown is going to end and what business is likely to look like for the next 12 months or more, I guess, before we're really in any sort of sense of normality. But I think the reality is that the world has changed. The world has changed for all of us personally and certainly economically. What was it? The buyers index. I was told yesterday they've just done the latest survey was standing at 12, and the worst point of the recession in 2008 it was something like 34. Anything below 50 is recession. So this is unprecedented times we find ourselves in. The key really is we are where we are. How do we get into recovery? How do we make it a V-shaped recovery and a very quick bounce back? Well, the onus is obviously on you, I, and everybody else in business. So thank you again for joining us. I won't rabbit on too much longer. What do we promise? So as a result of today, we promise you a number of things. So firstly, what we're going to do is we're going to go through a business planning and forecasting workshop. My colleague Mark will be running that in a minute or two, showing you what best practice looks like and how you can achieve that. Including a number of guidances and some free guidance on how to prepare your business plan. We're going to give you a forecasting tool completely free of charge as a thank you for coming today. It's really nice and easy, and Mark will sort of talk you through how that works as well. Including with that is a free report generator. So whether you're looking for CBILS loans today, or more importantly really is once we get out of the current situation, what's your cash flow requirement likely to be? What's your capital requirement going to be? And how can you then pull the reports together that are going to be increasingly necessary going forward? So we're going to give you a tool to enable you to do that. As a thank you for joining today, you'll also get an email from me later on this morning, straight early afternoon, with a link to a free cost saving and opportunity analysis tool. Highly recommend that you take advantage of that. It's a fantastic piece of kit, and I guarantee it will pull up something that you haven't already thought about. So, answers the question, why are we here? Well, we're here really to help you do this. It's vitally important that we know where the business sits, not only today, but where it looks to be going in the next 12 to 24 months. So we will help you to create a 5-year forecasting plan, which includes a detailed month-by-month profit and loss balance sheet and cash flow forecast for the next 24 months, 2 years. And then we'll also enable you to project further forward into years 3, 4, and 5. Clients often ask me, what is a forecast? And at the end of the day, a forecast is only really that, isn't it? Lick your finger and stick it in the air, see which way the wind's blowing. But we're going to enable you, we're going to help you and give you the tools and the resources at the end of the hour or so this morning to be able to go away and do this in some detail with a bit more science attached to it than just sticking your finger in the air. Really, it's there to help support funding requirements, but equally it should be, the finances have got to be the fundamentals to any business plan. So any ongoing business plan, you've got to understand the numbers. My mantra, turnover is vanity, profit is sanity, cash is reality. That's never been truer than it is today, and it's never likely to be truer than it is over the next 2 to 5 years. So we'll give you the tool that will enable you to, literally at a push of a button, give the banks or the other lenders anything that they might need with regards to further future fundings. And the big surprise really today is that the model that they're going to give you is completely accounting system agnostic. So now, obviously, if you're on a cloud accounting system, you'll know that we're big zero advocates here at Burgess & Bullock. We can link directly into Xero, and that makes life a whole lot easier. But if you've not seen the light yet, if you're still sitting on Sage or one of the many other tools, whether it's a desktop system or an online system, it doesn't matter. The tool we're going to give you this morning, you can use regardless. So hopefully you'll find that very useful. So specifically, we'll be looking at data input templates, profit and loss and balance sheet, how you get your historic information into the system, how to establish your baseline forecast, so your profit and loss forecast, what it's going to look like with certain assumptions in place. So where we are today, what's the business likely to look like? You know, we've had the lockdown, what's the impact on that? How quickly are customers likely to come back? What's going to happen with regards to supply chains? We've still got Brexit 7 or 8 months down the line here that we need to be thinking about. So this is what we would call your baseline forecast. Mark will go into this in a bit more detail. We'll flow through your cash flows and what then happens on your balance sheet. And then crucially, the tool will enable you to look at what's making some adjustments that are likely to happen should you get your funding. So, you know, if you're looking for borrowing for a specific purpose, what's that going to impact? So without changing your base forecast, so you'll still have, you know, if nothing happens, this is where we will be. If X, Y, or Z happens, then this is what the likely output is going to be. And I get quite excited about that. And then we'll also show you how to generate the reports and as a result of that, funding proposals. And then, as I say, at the very end, we will give you, as a thank you for coming, a really neat cost saving and opportunity analysis tool that you can use this afternoon. And I strongly recommend that if you don't do it this afternoon and it's a bit cold and wet on Sunday, which is forecast to be, spend an hour on Sunday, go through it for your business. I guarantee you will get some benefit from doing that. You might get a bit of grief from the other half, but hey, what the hell? Business is more important sometimes. So, let me introduce you to Mark. Mark's a colleague of mine, a very, very intelligent guy, been working in finance for a number of years and sort of works on the dark side, if you like, so mostly works in industry. Mark is a financial analyst and business intelligence expert, and I'm going to just stop sharing my screen now. So Mark, you can jump on, and there you go. So if you want to jump on now, Mark, and then you can take it from here.
Thanks very much, Sean. Hi, everyone. As Sean so very eloquently put, I'm a member of the dark side. I'm not quite sure what the dark side is. However, my job here today is to take you through exactly what Sean's just summarised there, just so we can understand exactly how you can use this free tool that Burgess & Bullock have made available to you in order to help you assist with business planning and also, if required, funding proposals as well. I'm going to kick straight into it. So I'm going to share my screen. So I'd appreciate just a quick thumbs up if everybody can see my screen. Okay.
Mark, could I just jump in? I forgot to say, if anybody's got any questions while we're going through, just pop them in the chat box, but there will be time for Q&A at the end as well. Yeah,
that's a good point. Good point, Sean. Yeah, use the chat, and like I say, we'll save them up till the end, and then we'll go through and we'll try and answer as many questions as possible. And then whatever we don't get around to, we can answer afterwards as well. So my job is to take you through the universal funding proposal model, which can be used for a number of purposes. It can be used just to prepare a forecast, or it can be used for more expansive purposes of actually generating a funding proposal. I'm going to take you through each of the tabs. And we should probably take around about 45 minutes just to talk through each of them, just so you've got a good understanding of exactly what's required. What you'll need to do, it is a simple model to use, but I just want to be clear on each of the individual steps along the way. As Sean said, we can use it with any accounting package. So I'll show you how we can incorporate data from any accounting package into this. Okay, so to kick off, we've got our first tab, which I'm not going to go through because I'm going to talk to it whilst I talk through everything else, is the process. So everything I talk to throughout this 45-minute session is neatly categorized and detailed on your process page. So you've got everything you need to do, and it's a good checklist to say, have I made sure I've accounted for all of these relevant steps along the way. So first step is, how do I get my information into the model? Sounds quite straightforward, and it is, and all you need to do is ensure you set your information up correctly. Unfortunately, on the model, you have two tabs right at the front, which is a sample P&L and a sample balance sheet. What they're there for is to highlight and tell you how you need to lay out your P&L and balance sheet, because then what we do is they get copied and pasted in, and then the model works automatically from then on. So we'll start off with the P&L, and it's really, really simple. My first column needs to include my P&L lines or my P&L nominals, however you want to refer to them. But essentially, if I were to print off a P&L from whatever accounting package you're on, essentially you'll get your first column will be your P&L lines, and then I'll have monthly information. Now you can put in however much detail you want to put in. However, if we just talk about the model from the perspective of a funding proposal, in the funding proposal you're going to need to show some history of business performance. So you're going to need to show how the business has performed historically. Coupled with that, you're going to need to talk to how it's going to perform in the future, your baseline, which Sean referred to. And then you're going to need to talk about the impact the investment has. So at this stage, the more history, the better. And I would say at least 2 years. So at least 24 months history, really, you want to be putting into the model. And the way you set the history up is the column furthest to the left, i.e. next to your nominal lines, is your most recent month. And then you just work backwards from there. Now, it really is 50-50, depending upon which accounting package you use, as to whether when you extract the data, it gives you it in that format already, or it might give you it in the reverse format, in which case you'll just have to move some columns around. But again, if you need any assistance doing that, then Burgess will be happy to help with that. So that's how you lay your P&L out, nice and simple and straightforward. And the balance sheet is even simpler. So again, I have my first column, which is my balance sheet lines or my balance sheet nominals, and then my second column is my balance at the same point in time as my most recent month. So in this case, my most recent month is March 2020. Therefore, I need to show my balance sheet at March 2020. I know I'm preparing this in May, but the information is correct to March. So that's what we need within the model. So that's how I lay my information out, and then it is quite simply a case of pasting that information into the relevant sheets. We'll start off with the monthly P&L. As you can see here, you have a yellow column, which is where you put your P&L structure, i.e. your account lines or your nominals, and then you have the months flowing on from there. So the next column is your most recent month, etc., etc., etc. So literally, I would do is I would go and I would go for my sample, I would copy that, and I would paste it into here. So I've already pasted in a sample set of data just for ease and to speed things up. Once I've done that, I need to give my company a name, and that's important because much of the reporting in the model refers to the company and the name of the company. And if I leave that as Demo Company Limited, it's not going to look good when you present that to any lender with regards to a funding proposal. So put your company name in there, and then all you need to do is tell the model which month this most recent month is. So, you know, if we're in March, great, and then it will work back. If all you do is you select from the drop down. Let's say it might be April, could even be December of last year. I would urge you to have as up to date a set of accounts as possible, but that's just essentially how you change the month and year. So we're going to go with March 2020 for the purpose of this demonstration, and then that will just work back from there. So then all I need to do is tell the model which category I want these particular lines to sit in. Now I've laid this P&L out nice and straightforward, in that I've got all my sales at the top, and then I've got my cost of sales, and then I've got my overheads. And I just therefore need to select the appropriate category from this right hand side. So essentially I'm just going to drag this down for ease. So I've categorized all of these nominal lines as sales, and that means it's going to pull all of that information through into the calculation. What I'm not doing is I'm not categorizing a header, and I'm not categorizing a subtotal or a total. I'm leaving that as select category, because if I were to pull through that total, it would effectively double my sales within my report. So all I'm doing here is putting a category against my individual account lines within my P&L. And then all I do is so that's my sales lines done. I then come down and I do exactly the same with cost of sales. Now, again, depend upon your accounting package, you may have cost of sales as an element, or you may have direct costs, and then there may be direct expenses, and then there might be overhead. So however it's laid out, it doesn't matter. All that matters is that you categorize it correctly. So if I've got all of these lines here, I want to just categorize them as cost of sales. So I can either drag the box down, or I can select the relevant line within here. And then, surprisingly enough, I then come down to overheads and do exactly the same. So all I've done here is I've written in a few overhead lines, and then I just literally select overheads next to all of the lines that I want to display as an overhead. And I'll stop there, remembering not to categorize a total or a subtotal or a P&L heading. If, as an example, I've got a line down here that for whatever reason I've set my chart of accounts up wrong and it's printed out wrong in my P&L, I can include this figure wherever I want. So if, as an example, let's say travel, let's say we as a company classify travel as a cost of sale because we only travel when we're on customer jobs, and actually it is a direct cost of sale. All I would do there, even though my accounting system has classified it as overheads and given me a report with it as an overhead, if I wanted to, I could include that as cost of sale. And what that would do is that would exclude it from the overheads in my forecast, and it would include it within my margin calculation. So I'm going to leave that as overhead for now, but that just shows you how you can, if you want to, alter your chart of accounts that you're given. However, I would argue you did that correct in the first place, and you did it actually within your accounting system. So that's the monthly P&L, nice and simple. I've set my structure up, I've pasted it in, and I've just assigned it a category. And then I come on to my closing balance sheet. So my balance sheet, again, is at the same date of my latest month. So what's my balance sheet as of March? I've pasted it in here. And again, I've named a few of these lines for ease. You can see here I'm not that imaginative with regards to my my assumptions around the values I'm assigning. And then you do exactly the same. So which chart of accounts category am I assigning to these fixed assets? Again, so these are fixed assets. Again, I'm not classifying a heading and I'm not classifying a subtotal. And I just drag that down. So these are all my fixed assets. Just change that one. And then I have current assets, which I will then drag that down as well. And then I have current liabilities. Now, one thing to look out for here is if I have you can set some lines up or some nominals up in certain packages to be floating balance sheet lines. Now, again, you may or may not be aware of this, but you may well, as an example, if in your bank account you are in an overdraft position at a point in time, it may or may not choose to put it in the current. It depends on your settings. It may include it as a current liability rather than a current asset, because actually you owe money on that. The best thing to do with those floating lines is label them and give them the category that they would ordinarily appear in. So if I had a bank, let's say that wasn't bank loan, let's say that was bank account, and it just so happens that I had I was in my overdraft and I had a balance on it, I would just then label that as a current asset, and in my forecast it would include it in my current assets line going forward, because ultimately we want a positive cash balance on our bank, right? Similarly, you might have a VAT account that might appear up here because actually you've overpaid VAT or something's happened for whatever reason and you've got a credit balance on there. You would then classify that as a liability to ensure that it's appeared in the correct in the correct category for your forecast going forward. And again, if you need any help at all you need to do is ask on that, and we can advise you on what the correct treatment should be. So I've done that. I've gone through my P&L. I've gone through, let's make sure I've done the rest of it. I've got one current liability, and what I've just identified a contingent liability, which might be on a court case. And then I've got my capital and reserves. And one thing which you'll then need to do, obviously, if you've downloaded this from your accounting system, it will balance. but it might be worth just checking and making sure that it balances after you've done this exercise. So I've gone through, I've listed all of my balance sheet nominals and I've categorized them. And that then is my start point. So now what I've done is I've got all of my history in there for my P&L, and I've got my balance sheet as at the same date as well. Now what I come on to this, that's the boring stuff. That's just taking in what has happened. Now I'm going to come on to talk about how I forecast performance going forward. Bear with me whilst I take a sip of coffee. So what you will find is you will now have a forecast, a baseline forecast tab, which is populated with all of the information that you've just entered. Now, I'll show you a quick example. I've got sales nominals 1 to 9 there. If I go back to my monthly P&L, if I then change these all bar one of them back to select category, you've now only got one nominal showing. So that's the relevance of selecting the category. It means you're including it within your forecast going forward. So I'll just set all those back to sales, so we include the full range. Similarly with cost of sales, similarly with overheads as well. So I'm now presented with the last 2 years worth of information by month about this particular sales nominal line. I may choose something I may have added. I may choose to reflect my performance by customer if I have that, and I may not want to use a sales nominal or a sales category or sales channel. Effectively, you can illustrate your sales performance however you want. And if you want to put your customer performance here, or if you're a retail outlet with 6 or 7 retail outlets, you could put retail outlet 1. So as an example, you could put retail outlet 1 through to 9. And that may be how I want to focus. It's all about how you want to articulate the performance of your business. So if you want to perform it to demonstrate it by retail outlet, you can do. Typically, your accounting package will give you the information, the P&L structure as a nominal structure, which is why it was set up as it is. So if I just undo what I've just done there, I'll leave it as sales nominal for now. So I've got a baseline. I've got my history over the last 24 months. If I go from top to bottom first, I've got my sales. So they're all of my sales nominals that I've put in. Then I have a space down below which allows me to enter any new activity or any new sales channels, any new customers. I'll come on to explain when we would use that. I then have a total for my sales. I then have a total for my cost of sales, which tells me how much margin I made in that particular month. And again, my cost of sales total is driven by the categorization of cost of sales here. And then I have the same for overheads. And it ranks these by total received or spent over the last 2 years. And it will just rank them for you. So you don't have to rank them. You don't have to rank the nominal lines within your P&L for them to display. They will always be displayed in ascending order. It doesn't matter where you put them on that P&L monthly P&L page. So here I've got my spend. So I've got my salary spend, my rent, travel, IT consumables, and then I lost the will to live and didn't bother to categorize anymore. I think I've got corporation tax in there. We've got depreciation in there, and we've got, I think, an interest payment in there, but the rest of them I've just left as is. Finally, going down, I will come on to talk about these yellow boxes in a second when we talk about the forecast. And finally, we come on to be able to articulate over the last 24 months the profit position of this business. So we've got, and this is why I said it's probably a good idea to get at least 2 years worth of performance in there, because all of this is going to flow through into the reporting, and we're going to be able to articulate and demonstrate movement in the business based on our history as well as our forecast. So we then come on to simple understanding of how those lines have moved this year, i.e. the last 12 months versus the previous 12 months, and what that is year on year. Again, being really imaginative and just applied a 5% increase across all of them, but they will be different. And then it comes on to talk about in the quarters what that year on year performance is as well. And that's important because you are provided with a starter for 10, if you like, which says how is that particular sales nominal or customer or physical outlet, however you have categorized these, how is the sales performance performed over the last 6 months? And I'm just going to assume that carries on going forward. So over the last 6 months, in fact, all of them have been 5% up. And then what the model does is says, okay, well, over the next 12 months, I'm just going to assume, as you're started for 10, that you'll continue that 5% increase. Now, obviously, there comes a point at which increase stops, and the real trick is understanding when that curve starts to flatten out. Now, flattening the curve, that's the particular point, isn't it? So what this is doing is this is applying 5% uplift to April of the most recent year, and just exactly the same for May. So any seasonality which is present within your business will continue to be reflected in the forecast going forward. You don't have to do anything. Now, I'm going to go specifically today, I'm going to talk about a worst case scenario, and I'm going to talk about a business that has to close as a result of the COVID-19 pandemic for a period of time and then takes a while to build back up. So we're going to talk worst case scenario, and I can do that a number of ways. I can either put in a percentage movement. So as an example, if this were in a normal trading environment, let's say, we might decide to apply a 10% increase to that client. That client might stay still. That client might actually go back by 5%. That particular sales nominal there, we might decide that we're not doing that anymore. In which case we just put -100, and that would wipe that out completely. So you can amend, you can keep the phasing, keep the seasonality, and just amend your year-on-year percentage assumptions by amending this column. If, however, and sometimes that might not be particularly relevant, let's say this sales nominal here represented a activity we only started in the most recent 12 months. What you would then have is you'd still be on your increasing trend, and you might choose to change the figures that you're applying in the actual month. So it may well be that I want to change that number, and I'll just change it. And it might be that I want to change that number there, and I'll just change it. So you can do it one of two ways. You can either use your percentage that you apply to just keep all of your phasing exactly the same and just apply an uplift year on year, or you can just go and type in the number you want to appear in that cell. You'll get a highlight, an orange highlight, which will tell you where you have made a change from the percentage applied, i.e. your most recent 6 months. And there's a reason for this being produced in Excel, because everybody's used to Excel. So if I don't like something, I'm just going to undo it. So there's me undoing exactly what I've just done. Now, what I'm going to do now is I'm going to say, okay, well, what would we do? How would we use the model to reflect a downturn in performance as a result of the COVID-19 pandemic? And what I'm going to say here is actually for April, May, and June, we're closed. Let's assume these nominals are sales channels. We're closed, so we're not getting any revenue in. And then what I'm going to assume is that for the following 6 months, we might be 50% down year on year. Now I can do that a number of ways. I can either key the number in, or I can just put -50%, because for every cell that has a number in it, we've still got that calculation feeding through. So that's assuming a 15% downturn now for the remaining 9 months of the year. Then it may well be that actually what we want to do is we want to reflect, yes, 50% down for the remaining 6, but actually we might only be 25% down for January, February, and March. And you can do that a number of ways. Again, because it's Excel, I can reference the actual year. So if I say next January, I'm going to do what I did this January, but I'm only going to do 75% of it. I just do that, and I copy that across. So what I've done now is I've for that particular line, and all I'm going to do is now copy this down. For that particular line, what I've assumed there is, so it's my most productive sales nominal. We're closed for the next 3 months. I'm going to be hit by 50% for the following 6 months, and then I'm going to be hit for 75% for the subsequent 3 months. Now, again, because I'm not very imaginative and interest of time, I'm just going to copy that down. And what that will do, if I assume that 50% as well, I've now reflected those assumptions right across the board. If you think it's slightly different for a particular, let's say, for whatever reason, this sales nominal is only going to be hit by 30%, then 25, you can change that to 30%. So hopefully you will get and understand the idea with regards to how you would project performance forward. If you wanted to, And if you couldn't really articulate a forecast at a nominal or a customer or a physical outlet level, you could set all of these to minus 100, in which case that would wipe out the forecast completely. Or you could just do that and wipe out the forecast completely. And then you could choose down here using the yellow boxes, because the yellow boxes are there for you to enter new customers, new sales channels, new nominals. You could put a one line COVID-19 forecast, in which case you might just choose to put, again, absolute numbers in, going across the page that way, and just have one line. I'm going to stick with it as I had it, by nominal, but that's how you would just essentially input one line. And I just want to, for this business, really, I can only get my head around what a total sales forecast might look like, and I would choose to apply it that way. So that's done for the next 12 months. What we then do is we then project performance forward for the following 12. Now, the months 13 to 24, just assume the same phasing as the previous 12 months. Just gonna take a sip of coffee. So as you can see there, next April, it's assuming no revenue, no sales, because we haven't got any sales in this April. So all we would then need to do is reflect assumptions for those months going forward. And what I'm going to do is I'm just going to apply, so I'm going to take April of the most recent 12 months. And again, I'm just going to assume that that 75% continues for a further 3 months. I'm pasting that information in there, and I'll copy that down by line. And then I'm going to assume that actually we just do what we did in the prior year, as an example. So we are now back to trading as per a prior COVID-19 pandemic environment. So from July so month 16, I'm going to finally get back to a position where I'm trading as per normal, and I'm going to assume I'm going to continue at that level for the rest of that 12-month period. Again, if I wanted to, I could just tweak individual numbers. You know, you can do whatever you want within the model itself. You can either apply a percentage, or you can actually key in a number. But let's assume that I'm going with that as my option for the following 12 months. And then anyone that can forecast that at a monthly level more than 12 months deserves a gold star. And if you can forecast greater than 24 months out, then you need to be playing the lottery. You really do. So for years 3, 4, and 5, we just put a total number in. And again, you can assume, so my total sales for that particular sales nominal in year 2, i.e. months 13 to 24 of my forecast, is almost 11,000. I can either apply a percentage uplift, or I can not apply a percentage uplift and just type in my number, what I want to reflect. And then that carries over to the following year. So again, a 0% uplift will give me what I had before, and I might just assume a small increase in that going forward. And there are maybe subsequent lines that actually you want to apply different assumptions to. So this may be a declining nominal, but like as you can see, quite straightforward to put individual assumptions in. So that's how I get to my sales forecast. Again, if I just go back, I've gone from a position where I've understood what's happened by month over the last 24 months, which has given me an understanding of my year-on-year performance and how that has performed by quarter. This was a nice simple scenario where everything was 5% up. I've then gone to a kind of almost doomsday scenario where I've had to close, unfortunately, and then I've built my business back up to a point where by July of next year, I'm probably trading on an even keel as to where I was this year, and then my growth is projected going forward. So that's how I do it for sales. And guess what? I do it exactly the same way for cost of sales, margin, and therefore overheads. So I'll just explain cost of sales. So cost of sales, again, we pull through our information from the most recent 24 months to give me a total for the last 12 months and a total for the previous 12. And that therefore gives me a margin, and that therefore gives me a margin rate to assume going forward. Now, in this instance, I do have a slightly different phasing of my margin for whatever reason. So my annual margin is actually 1.4 percentage points up, but my margin over the most recent 6 months is only 69.7. So again, we just need to understand, it will give you the last 6 months as a projected starter for 10. We just need to think about, is that reflective of a full year's worth of performance? If it is, then we just leave it. If not, actually what we then might choose to do is just increase that number. So either we apply 71%, which will apply 71% across the board, or we might choose to put a specific percentage in a specific month, 65% there. We may choose to follow the exact same phasing as the previous year, in which case you just equal the previous year. So there are lots of things that you could do. I'm going to leave it at a standard 71% for the next 12 months. And then I'm going to assume that actually we managed to increase margin by 0.5% each year thereafter. And again, you can choose to you can choose to adjust the annual number, or you can choose to adjust the monthly number, however you want to do that. So let's assume we go up to 73. Okay, so we've done our margin assumptions, and now we come on to look at our overheads assumptions. Now, overheads, again, treatment of the forecast going forward will be specific to specific overhead lines. That's me. I'll put something in earlier there. So effectively what we've got now is we've got our overheads, which are ordered based in descending order based on their cost, i.e. the most costly nominal at the top, which is 9 times out of 10 it will be salaries. And now we just need to put in the impact of, again, our trading environment on our overheads. Now, what we've probably done in this instance is we've furloughed staff. We may or may not be choosing to top up some of that payment, but you just need to work out what your monthly spend will be in a furlough environment for this business. Now let's assume it's costing us £500 a month because we're topping some pay up for a few individuals. We know we're going to be 50% down in the next 6 months. So again, we can either apply a percentage to our previous year, or we can put in an actual number. So for ease, let's just put in £3,000 a month for the next 6 months going forward. And then we may well choose to remain at our, by the start of next year, we're probably going to operate at the same level as we always have been. So back up to just under £7,000 a month for our salaries. And then you need to check the following 12, because the following 12 will just use what we've used in our first 12 months forecast. So again, what we may just choose to do is go back right and say, I'm now just going to reflect what April was in my most recent 12 months. And then I'm just going to copy and I'm going to reflect that forward. So you can see it's nice and easy to just reflect that performance forward. So now I've got that feeding through into my forecast now going forward. And again, so I'm not going to change every single line within here. So, but another one which you may decide that all travel has stopped over the next 3 months. We're then going to kick it in because we're then going to start to do some work. And I then just need to go in and ensure that in my following 12 months, I've got my spend forecast back in. So I've got an accurate full year position. You'll go down each of your overhead lines. I'm just going down a few in the interest of time. I will bring your attention to a couple of lines and why you'll see some funny treatment. So anything identified as corporation tax, it will automatically apply a minus 100% to, because corporation tax is worked out on one of the following tabs. So don't include any corporation tax in your forecast. Anything which is classified as depreciation, it will do exactly the same to you because your depreciation assumptions come elsewhere. Obviously, that's very important for your, going through what Sean said at the start. The funder will look at this in the complete reverse order that you might look at your business. They'll look at your cash flow, then they'll look at your balance sheet, then they'll look at your P&L. So what we're doing here is we're ensuring that those cash flow and balance sheet assumptions are correct, and then they are reflected in the P&L when we present the P&L. So depreciation, corporation tax, and interest, I think I've got interest down at the bottom, there we go, and interest will be essentially zeroed out, and they are, and your assumptions are accounted for elsewhere. So if you see that, leave it, and then we'll come on, so you'll understand where we include those assumptions going forward. What you've then got is you've then got a line, you can add new overhead lines if you want to. So there's space to add new overhead lines if you need to. And then you'll see down here this bad debt line. Now you may well have bad debts within your overhead nominals. If you've got those within your overhead nominals, don't forecast your bad debts in that line, forecast them in this line, because what that will ensure is that not only the correct treatment is applied in the P&L, but the correct treatment is applied in your VAT and your accounts receivables as well. So that's why we've got a separate bad debt line here, to ensure that the assumptions are consistent across the model. So I've gone through now, I'm now at a position where actually I've gone through my performance. I can see that my profit that I had been making of 214,000 last year compared to 175 in the previous year is now looking like it's going to reduce and go into a loss of around about 73,000, and we're going to be back up to making a sensible profit in the following 12 months, and then after that the business is going to grow 255, 260, 269. So that's and if you think about it as that's your trading position. That's what's going to happen in this business now over the next 5 years. The next couple of tabs we're going to come on to now refer to or now relate to the relate to the balance sheet, and then the cash flow and balance sheet forecast. So first step, I've already told the model what category my balance sheet nominals relate to, and so they will be presented over here. So as an example of stock is obviously within my current assets. If I go back to my balance sheet, I pick on stock, and actually for whatever reason I want to include that as a current liability, what that will do is you'll now see stock in your current liabilities. I know it's not a current liability, but you'll see it there. So let's just change that back. So we've got our nominals classified. Now I need to talk about the treatment of those nominals, and this has a big impact on your cash flow forecast. So we've got stock in this business of £116,000. Now the treatment I want to apply to that is stock work in progress. Now that means that all of the stock, I say all, the stock assumption that I assume within my three-way forecast is going to apply to every nominal I classify as stock or work in progress. The assumption that I make around accounts receivable is going to apply to every nominal that I assign a receivable category to. So I think you'll understand where I'm going with this. Bank account is cash. Rent deposit, well, actually something like a rent deposit is just going to stay the same. It's 15 grand. It's going to stay in there. I've got it for probably the next 10, 15 years. So I'm going to just treat that as other. And what other means is, look, don't apply any assumptions to this line and just assume it's going to stay the same throughout my forecast. And then a PayPal account I've also got, I'll put that as cash as well. So now I understand from my current assets what my cash position is, what my outstanding receivables are, and what my stock position is. And then I've just classified some things as other. And then I do the same with my current liabilities. So again, it should be relatively straightforward to work out what treatment to apply. So my accounts payable is payable. I have an outstanding corporation tax liability. I have an outstanding VAT liability, which I'm going to classify as VAT. I have a PAYE liability, which is payable. I have a bank loan, which is debt. If I can find it, there it is. And then we've got a pension liability. And it may well be that all of the payroll liabilities just roll up into one line on your particular balance sheet. We'll classify that as payables. In our long-term liabilities, we've got something that relates to a IP for a court case. essentially what I'm going to do there, I'm just going to call that other, as in I don't want to impact any of my assumptions, or I don't want any of my assumptions to impact this particular line. And that's what setting that to other will do. So now I've got, and again, any help required, then you just need to ask for what treatment I apply to these. What that will then do is then that will generate everything I need for my three-way, i.e. P&L, balance sheet, cash flow forecast for the next 5 years. So I've gone through the assumptions I'm going to make around my trading performance. I've classified my balance sheet, and now I just need to work out, work out what my cash flow and balance sheet impact assumptions are. So hopefully everything flows in a methodical order, so you can follow it. Then all I need to do is put in my assumptions going forward. So I'll go from top to bottom, and actually what you'll probably see is generally the most important assumption is at the bottom. Actually, I will increase that. So first off, what depreciation and amortization percentage am I going to apply to any capital investment or any outstanding balance of fixed assets? It will pull through what is currently being reflected in the year, and that may or may not be accurate with regards to what you want to, because you may have had an asset write-off, you may have all sorts of things may have happened in the year, or you may have accelerated depreciation. Things may have happened in the year which will mean this number may or may not be reflective. If it's not, all I need to do is put a new number in there. So if I know really my depreciation is on a 25% reducing balance, I'll just put 25% in there, and that's what's going to drive that forward. So every month for the next 24 months, I'm applying a 25% depreciation assumption, and that's just going to continue going forward. I then need to have an assumption around interest. Now this is for existing debt within the business, because we're not talking about our new funding proposal yet. We're just talking about existing business performance. So what this has said is that based on what you've told me, based on what you've put into the model, your current interest percent is 12.6%, rather high, and it's going to apply that going forward. Now again, there may be something within your accounts which is inflated, or maybe the interest charge isn't quite what it should be within the accounts. I can just change that. So if actually the rate is 7.5% to apply, I'll apply my 7.5%. And again, that will continue going forward until there is no debt on your balance sheet. Now this is just the interest side of it. The capital repayment comes further down. Then I need to put an assumption in around corporation tax. So I know that my current liability for corporation tax is 15,000. So I have that, it's in my balance sheet. I've assigned that as corporation tax. So I know that my opening position is I have a liability of 15,000. Now, as you recognize corporation tax in the period it relates to, but don't pay it, well, for as long as you can, the cash payment actually happens a lot later. So let's assume for this bit, let's assume that we've got a March year end, and that this was the year end position. So we know that we're going to pay that, let's say we're going to take it right to the wire, or so we're going to pay that in December. What we're then going to do is in March, we are then going to recognize another corporation tax liability for the year. Now we can do one of two things. I'd take some advice if I were you. In this business, we know we're going to lose money over the next 12 months. And as March is our year end, we may actually be carrying some sort of tax credit through for the following year. Or it may well be that there are some other things that impact your tax position. So with regards to tax, that'll be an area where you might want to look for a little bit of help. But let's assume that there's a carryover or something. Let's assume that our tax is going to be, I don't know, £2,000, and that we're going to recognise in the accounts the following year. We know we're then going to pay that in December. So we're going to pay that £2,000 in December, and then we know that in March of the following year, we're going to then reflect another corporation tax liability. Now I know for that year we're going to generate 212 grand's worth of profit. So let's assume for ease that's going to create a 20 grand tax liability in the accounts. We're going to pay that the following year, and we're going to incur a further 25 grand tax in the following year, which we're going to pay in year 4. And in year 4, and again, I'm clearly just making these numbers up. In year 4, we're going to incur a 30 grand tax liability, which we're going to pay in year 5. And then in year 5, we're going to incur a 35 grand tax liability. So all we're doing there is taking into account the difference in the timing between when the corporation tax actually shows in your P&L and when you actually pay it. So that's what those two lines are there for. I then need to look at the owner of the company. So typically the owner won't take any remuneration, or they'll only take part remuneration through the salaries line on the P&L. And they'll take the rest of it through a dividend payment as a result of having distributable profit. So let's assume now we're reflecting that actually this business owner, 15 grand, requires £1,500 a month. So I know I'm going to be closed. However, I need to take 1,500 quid a month out of this business just to live. So we're going to put that as a figure for the next 12 months. And then I'm going to assume the following 12, okay, I think I can cope with another 1,500 quid a month. It's going to need to go up after that. So I'm going to get 2 grand a month in year 3, 3 grand a month in year 4, 4 grand a month in year 5. So that's my assumption, my aspiration. It might well be actually that you say, you know what, I'm going to stick it at 2 grand a month. And I may or may choose to increase that. So I've put in my assumptions around depreciation, interest, corporation tax and dividend. One thing I missed off, which I've just seen, is my assumption around my inventory. Now within this business, the calculation, again, based on what we've told the model around our stock levels and what it knows about our cost of sale, we've got 156 days worth of inventory within this business. Now, that's not to say whether it's good, bad, or indifferent. It may be reflective, it may be high, it may be low. Can't see it being low. What we would then need to do is show to the bank or the lender that we don't want the lender to take all of the capital or working capital risk. And actually what we may choose to do is actually show that we're going to be a bit more efficient in our stock control. So, you know we need a certain amount of cash to pay for stuff in this business going forward. Actually, what we're going to show is that over time we're going to reduce that number. So we may well choose to say that, let's say we need, I don't know, 120 days. Let's say 156 is a bit too much. We might show that over time, actually, we're going to reduce that down. So over the next 3 months, we're going to reduce that stock figure down to 120 day stock. We may choose to go further. I'll show you the impact that has now on your stock levels within your business, because what that's going to do is we know we have a stock level which is at 115,000, and we know we're going to reduce down to 120 days stock. So if you couple the reduction in stock with the reduction in revenue over the next 12 months, what that actually means is that as the business, you are, through your working capital, reducing that stock position down to 40,000. Then as your revenue starts to pick up, you're then back to a position where actually 83 grand is now more reflective of a full year's worth of stock days based on proper trading and at 120 days. So that's how that impacts your cash assumptions. It's not physically cash. Essentially what you're assuming there is that you're using stock, you're not purchasing stock to sell, effectively, is what that's assuming there. So that's a really important one. And I got a real life example of last week, someone used the model in that exact example, because the bank weren't willing to lend them 350,000. They were willing to lend them 250,000, and what they had to show, and they had 200 days stock within their business. What they had to show within the plan is actually, I'm going to meet you halfway. I'm not going to request the full 350. I'm going to request 250, and I'm going to show how within my working capital management I can facilitate the other 100 of that. So hopefully that makes sense. If not, again, feel free to ask questions or ask independently afterwards. Then I've got assumptions around capital expenditure. So have I got any additional capital expenditure forecast in this business? And let's assume that, I don't know, I'll put 50 grand in October, because that's in my business plan. I need it in order to be able to facilitate my sales and my sales growth. So I've got 50 grand capital requirement in. Then I've got debt issued repaid. Now again, this relates to existing debt which is within the business. So if I go back down to my balance sheet at the moment, I can see that from a debt perspective, I've got £5,000 that's outstanding. So as long as there's debt, there will be an interest charge on that debt. So let's just assume actually I've only got 5 months worth of debt of repayment left. So by the time I get to August, we'll now see that actually there's no debt on the balance sheet. And if we go back up to the P&L, what you'll see is actually there's no interest therefore on the balance sheet going forward. Sorry, on the P&L going forward. I've also got the facility in there if I'm going to issue any equity, or if I'm going to do some sort of share buyback or anything like that. So if I need to include that, I can include that in that line there. So they're my assumptions around generic cash and working capital, and I'm ensuring there that I'm accounting for my corporation tax correctly. I now need to come on to what are probably the three main impacts on cash flow over the next 12 months for this business, and that's VAT, accounts receivable, and accounts payable, or debtors and creditors. So I then come down to the bottom of the sheet, and the first thing that I do, like I don't think I mentioned it, so you can only input in the blue highlighted cells. If I want to change a number, I can't. You won't be able to change it, and the reason is because all of the blue cells are drivers towards a calculation, and everything else is just a calculation. So you don't need to change those. So first of all, I'm going to look at my VAT and my VAT assumptions. I'm going to assume for ease, this business, everything that it sells is a VATable product. So my output VAT rate is going to be 20%. If I have a mix of products, and some products do incur VAT and some products don't, then my mix will be different. And again, you should be able to get this from your VAT returns, but we're going to assume for this business that everything is chargeable at 20% VAT. Then I need to look at my input VAT rate. So this excludes anything classified as salaries within your P&L forecast. So if you've got salaries or gross wages or anything like that, this excludes that as an assumption. And things like certain utilities and other elements of expenditure, travel, things like rail and flight won't incur VAT. So it depends on the makeup of your business expenditure. But then you need to put your average input VAT rate. So let's assume it's 15% for this business. Let's assume most of the expenses it incurs have VAT charged on them. So then all I need to do is understand what my VAT cycle is. So is my VAT cycle Jan, April, July, October, or is it February, May, August, November, or March, June, September, December? So whichever one of these is relevant, you select that in the drop down there. Now what that does is that again drives your starter for 10, doesn't necessarily or it doesn't mean that you're stuck with that, because the way that the model then works, it says what's my opening VAT position. So I know I owe just over 11,500 on VAT. Now I've got that from me classifying this VAT liability as VAT. If this was a VAT line and I classified that as VAT, what we would now have is an opening VAT position of 20,000. So I'll just undo that. Again, I'm trying to help you understand the impact certain changes make to the model. So I've got an opening position of 11,500, which is my opening position for April. I'm not doing any sales in April because I'm closed. So there's no output VAT in April. I've still got expenditure, and expenditure which is going to be at an average VAT input VAT rate of 15%. So therefore my net movement in my VAT liability is actually downwards in the month. So that's one positive from being closed. It's not a big positive, but actually my liability has now reduced. The cycle you select here tells the model when to assume a VAT payment. So what this is saying is that February, May, August, November. So May is the end of your VAT period, and we're assuming that at some point in the following month you pay your VAT. Now, I'm aware it can go over into the following month, and some businesses, if they're really watching their cash flow, will actually make that payment go over into the following month. That's fine, because all you would then do is reflect that payment in the following month. So what this is assuming is that my outstanding VAT in May is 4,339, and that will be paid in June. So my calculation for June is what's my starting position for VAT. Again, I haven't done any sales in June, so I'm not starting to do sales until July. So there's no sales in June. I've got expenditure, which has got input VAT to it, so my net movement is negative. I'm going to pay my previous month's VAT. So actually, I've now got a position where I've got a negative VAT balance because I paid what was outstanding, and then I'm starting afresh. Now, if I'm not actually going to pay that until the following month, I just delete that and put that 4339 in there. If I'm on a VAT payment plan, which actually might reflect the fact that I'm just paying £1,000 right across the board, I can reflect that there, and that will give you an up-to-date VAT position at any point in time. I'm going to leave it as it was previously assumed within the model, but again, you can choose to reflect your payments however you want. The key is this is when you physically pay your VAT. You've got an assumption in there to give you a guide, but then you can choose to overwrite that if you want to. And if you've got a 6-month VAT payment holiday, we'll just delete that because your balance just carries over and continues to build up based on your trading performance within the business. So let's say I've got my next VAT payment is going to be December, at which point I'm going to have to pay all of my outstanding VAT. So I know I've got 17 grand payment due in December. Let's leave it as that for now. And then we come on to our next two probably crucial, well, not probably crucial, and crucial assumptions, which are around accounts receivables and accounts payables. So let's stick with receivables for now. So we know in this business we have an opening balance of receivables of 76,452. And again, if I go back to my baseline balance sheet, it's that number there because I've classified that as receivables. If this was a receivables line, I classify this as receivables, and that increases that number now to 84,306. I'll just undo that, put that back. So what we then do is say, okay, well, what was my receivables at the start of the month? What were my, sorry, I'm on payables there. What were my receivables at the start of the month? What revenue have I achieved in the month? I guess I haven't achieved any revenue in the month. So what's my total position at the end of the month? And then we say, okay, well, how much of that total position am I expecting to receive? So what we're trying to do here is actually, you just need to focus on this number here. So this is saying you're going to receive 38 grand in April, and 19 grand in May, and 9.5 grand in June. Now, in a business that deals with instant payments only, i.e. it's either cash or it's by debit card transactions, credit card transactions, this would always be 100, because, and you'd have no accounts receivables because you received everything as and when anyone swiped their card or just gave you the cash. So that's how you would reflect in an instant cash business, and you'd have something in the really low thousands for your receivables, which might relate to a few invoices you've got outstanding. So I'm going to flick that back. So that's not relevant for this business. What we do have down here is an understanding of what your accounts receivables and what your accounts payable days have historically been for the last 12 months. So this is saying actually both is around about 30. So we know that 30 is a reflective position for this business going forward. And we actually know also that we're closing for the next 3 months. Likely it is, if we're a B2B business, a lot of our customers have closed. Also, if we're a B2C business, a lot of people are watching their spending at the moment, and probably aren't going to pay us. So what I'm going to do first of all is say, okay, well, let's assume a bad debt position. Because what we need to do is then assume, because that will then flow through and make an adjustment to our accounts receivables. So again, remember I went back into our forecast, and remember I said at the bottom, we've got a line which we use to assume bad debt. So I know that you know, or I reckon around about 25 grand we're going to have to write off as bad debt, and let's assume we're going to do that in July. What that will do is that will ensure that as of July, the correct VAT treatment is applied, because we've already probably recognized that VAT, and also our accounts receivables are adjusted accordingly. So we've got that in there now, and now we're going to say, okay, well, what do we ordinarily expect to receive going forward? And let's say we're going to be hit hard over the next 3 months, and actually we're only going to receive 10% of what we've got outstanding. And then we know that with it, we think we can grow it slightly from then on, but it's going to be a real slog, and we're only really going to get back to around about 50% of it by the end of the year. And then actually, if we want to get back to our 30 days accounts receivables, then that actually is going to take some time to flow through, and it may be that it takes, you know, until by the end of the following year to actually flow through and flow back to around about that 30-day mark. So again, this is reflective of an average position for a rolling 12 months. So by the end of year 2, we're back to a point where actually we're now at 30 days debtor days again. And we may have a similar assumption that we're going to apply to payables. Now, the unfortunate thing about payables is a lot of what we pay may be on direct debit, and it may well be that we have no control over stopping that payment. And if we stop that payment, we don't receive the benefits of that service. So we might not be able to reduce our payables by as much as we think our receivables are going to reduce. So let's assume 25%. Let's assume we maintain that for 6 months, and then we're back up to 50%. So, and again, as we can see there, our payables number is hovering around about that at 29, 30-day mark that we have historically operated at. So there are our assumptions. So it's methodical, but there are assumptions that you need to cover off, and you need to be able to show, you need to be able to demonstrate the fact that you've thought about all of those, because that's going to drive one line really that you're interested in on your balance sheet, and that one line you're interested in is, well, what's going to happen to my cash position now? And we can see here that as a result of all of those assumptions flowing through, we've got a real sticky point in December. Actually, well, we get to it before December, but it gets to a point where in December now we've got 150 grand cash deficit within this business. And then as we start to trade out, we start to get back into a cash positive position, and we can see that actually when we trade out, by the end of year 2, we're up at 71,000, and then years 3, 4, and 5, because we're back to trading normally, we've got some real strong positive cash growth. And it may well actually be that in years 3, 4, and 5, we can start to take more dividend. But you ain't taking it before then, because the likelihood is that you can't afford it. So that works out what our cash position is now going to look like in that business going forward. Now we know that we're not going to get to years 3, 4, and 5 because we're going to run out of cash. We're going to run out of credit. We're not going to be able to manage ourselves out of that. We've put our best assumptions within the business. We've reduced our stock levels to show that we're trying to manage some of that working capital ourselves. We've taken a reduction in dividends to show that we're going to try and manage that ourselves as well. However, we just can't get away from the fact that we are now at a point where we're going to be 150 grand in deficit of our cash position. So now what we need to do is say, okay, well, we need some funding. Now this example that I'm giving you is a worst case example in a COVID-19 environment. But as Sean said at the start, you can use the model for all sorts of funding scenarios. What I'm going to do is briefly talk to you about this funding forecast tab, because it is important, although we're not going to use it in this particular example. If I go back to Sean's example of you might want to borrow some money for I think it was like a piece of machinery. It might be that you want to invest £500,000 in some machinery, and that machinery will mean that you can effectively, increase your output by 25%, and therefore increasing your revenue by 25%. That additional revenue will come with additional costs, and you may have to employ some people to operate the machinery. How you would allow for that is on the next tab. So the funding forecast, it is essentially the trading implications of that investment. So if I invest £500 in new machinery, I am going to be able to increase, I'll use 20%, sales across all of my nominals by 20%. What it will then do is apply the assumed gross margin rate. So I'm not going to change my margin rate. So therefore my margin rate is going to be 71%. If, however, that machinery not only increased productivity and output, but also it made it a lot cheaper to produce our goods sold, what I can do is I can put an impact on margin, and actually that might reduce our margin rate by 5%, that might increase, obviously, going the other way. That will increase our margin rate by 5%. So now, actually, I'll get it right. Now, actually, we've got 76% margin. So we've invested in machinery. It's going to increase our output by 20%. It's going to give us better margin. Actually, what we're also going to need to do, therefore, is increase our salaries by, let's say, 20%. So we need to hire some more people to operate that equipment. And that's effectively how you would deal with the trading impact of the funding, not the actual funding itself. That's on the funding three-way forecast, but the trading impact of the funding. So hopefully you understand how that works. I'm gonna undo all of that, because this particular instance is literally just about applying for cash, a Sybil's loan, if you like, to help you trade out of a poor period. Because I've already demonstrated I was profitable. I'm not going to be for the next year. It's going to be a bit touch and go for the next 16 months, actually. And then after that, I'm going to start to make a profit, and then I can start to repay some of the loan. My funding balance sheet is there for information purposes only, because I've already set my baseline balance sheet. So there's no reason why that should change. That's just there for information. And then I come on to the funding assumptions. So we've already pulled through all of the assumptions that we've made from the previous tab. So we don't need to redo all of those assumptions. All we need to focus on here really is the debt that we want to, or the amount that we want to borrow. And also we need to focus on the rate at which we're going to borrow at and when we're going to repay. So let's go down and let's have a look again and have a look at what our low point was for. So we're around about 150 grand low point for cash. We're going to allow some contingency within there. So actually, let's say in August, we need to ensure that we account for that £1,000 payback from the previous, but let's assume we're going to borrow, let's say 174, but we're going to borrow 175 and we're going to pay back that other £1,000. So we're going to borrow £175,000 in August. Now, we know our existing debt has reduced down to 0 by August. And actually, we're not going to start to pay any interest on this debt now for, let's say, 8 months for ease. Let's do it until the start of the next year. So all you need to do is reduce that interest payment to nothing. What that will then do is that will not apply any interest in your P&L for that loan until April of next year. And then all we need to do is ensure that we account for the capital repayment, because we've already got, actually, let's say we get it a bit cheaper rate as well. Let's say we get it at 5%. Yeah, let's say we get that at 5% going forward. And then what we're going to have to assume is when we repay the capital, and then we're going to have to assume when we repay the capital on that loan. So let's take, I should have thought of this beforehand, let's take 175 and we're going to divide that by 5, let's say, so 35 grand a year. So divide that by 12, that gives us 29167 per month. So we're going to start to repay it from April. we're just going to assume that on a monthly basis going forward. So there's our 35 grand repayment for the following year, and then minus 35,000, minus 35,000, minus 35,000. So at that point in time, so we have reduced our debt. By the end of this forecast, our debt position is now, so we've got 36 grand remaining debt outstanding. So we don't need to show that when that's going to be paid off. We just need to ensure that we've reflected those payments within our forecast assumptions going forward. And then we can see, which is the key element, which is within all of this, is now we've got a cash position which actually only gets as low as, we've got 6 grand in July, and then we've got 26 grand in December, which is what previously where I think when we were at 150 or 149. So I'd say we've now shown the impact on the business that that cash injection has had. We keep all other assumptions the same. We've no need to change any of those assumptions. We've kept them all the same. So that's our if you would say, if you just want to print that off, then you can do, you can print it off, and that will give you a detailed understanding of business performance. So you've got one page which shows you the next 12 months, your assumptions, your P&L and your balance sheet, your cash flow, your supporting schedules and your assumptions. Again, so I've not gone into the understanding of the working capital movements, but it's all there. You can see it all. Then that's exactly the same for the following 12 months, and then exactly the same for an annual perspective for the next 5 years. So that's the numbers. Now, actually, we need to add some qualitative information. We need to put some context into what this is for. So we've got that as set up as the model, and that's there. And now what we need to do is actually we want to generate a funding proposal. So what we do is we click, let me show you that again. You got this button here. Now what this does when you click this button is first of all, it says, it asks you where you want to save this funding proposal. So all I'm going to do from my perspective is I'm just going to save that to my downloads. I'm going to save it to my downloads position. You'll get a little box come up which will tell you when it's completed that. Now, what this report does, if I go and open it, this will now give you everything you need to make that funding application, that funding proposal. It tells you what you need to include, and it also tells you why you need to include it, and where possible, it will even populate the information for you. So the funding proposal is a 6-page document, and what you've done up until now has pointed towards this document. This is a document that you would discuss. You wouldn't necessarily discuss all of your workings. So what do I need when I'm talking to a lender about potential funding requirements? What we've done is we've gone down and we've provided the boxes to input the information in, along with a little tooltip around what do I need to include and why do I need to include it. So I'll just very quickly go down. We've got an executive summary which talks about, very, very simply, how much am I requesting, why do I want it, and what will it be used for? Then I need to give some context about the business, and this is there so the lender knows that you understand not only your business but the environment within which you operate. So there's some things you might want to include to the right-hand side. We'll look at financial performance, and this is where your history comes into play. So the history that you've loaded will be reflected in your financial performance, and it will give you an articulation of that performance. If you only load 3 years, it will give you 3 years. If you only load 4, it will give you 4. So, but for this one, we've loaded 5, and therefore we've got some commentary which talks about performance. If you don't want to use that commentary and want to write your own, then it's fine. You just overtype it. You can put in wherever you want. We'll leave that in there for now. Then I've got some graphs which talk about revenue, margin, profit trends, net worth. So we can see within this business, we're in a business actually that has grown and grown consistently over the last 5 years. One of the key eligibility criteria is that you had a viable business before this pandemic hit. And here, very quickly, we can articulate that we did. And then we've got some information around the phasing of revenue and performance over the last 2 years. Then we're going to need to articulate the internal strengths and weaknesses within my business, as well as the external opportunities and threats. And again, this doesn't need to be exhaustive. All it needs to be is the main 3 to 5 points in each of those sections. And again, you've got a tooltip there which helps you understand, okay, well, what do I need why am I even putting this in, but also what do I need to include? Then we've got information about the funding requirements. So we know we're asking for 175. They need to know what you're going to spend it on. So I think I assumed 5 years, no, I assumed 4 years of that. You need to know what you're going to spend it on. So I think from memory, we had 150,000, which was to cover COVID-19 impacted cash shortfall. And I allowed £25,000, which was contingency. So all this is for is to ensure that you can break down that 175 exactly. So obviously, if this is for machinery or this is for other types of investment, you just break that down there. So you're given a full detailed list of what you're going to spend it on, not necessarily to the penny, just the main subject areas. Then we have a line which actually talks about the impact the funding has on the business. So in this instance, it doesn't have a great deal of impact. In fact, I must have left one of the increases in on the funding tab. But we talk about the impact that the funding has on the business, what it will do to the P&L, what it will do to the balance sheet. So we've got the commentary here that the cash flow is expected to increase from minus 153, which it was at one point in one of those months, now to plus 6. We then come on to show, to give you a box where you can input the assumptions. So any key assumptions which you've input within your forecast, that's where you want to put them there. And then we show a graphical representation of what that funding does to the business. So here it doesn't really impact the P&L considerably because we're just talking about the cash position. But again, we can see that cash balance under our baseline was negative, and actually the cash balance under our with funding proposal is now positive. So we can show that we've demonstrated this will help us get through a period of an adverse cash balance. Then what our forecast is. So here we can see we're not going to make any money at all, any revenue at all in the first 3 months, and actually we're going to have a huge loss the first part, again, because this is a seasonal business as well. We're going to have a huge loss the first part of the following year, and then just an articulation of what that means on a rolling 12-month basis. And then if I want to include any other information, there's the space to do it. If I want to attach other documents, obviously you can do, but that's the place where I would put any other information you feel is relevant. And then I've got some appendices which just go through and talk to the profit and loss, how that's performed from this year to next year, and then the following 4 years. Same from a balance sheet, same from a cash flow statement, and then all of my working capital assumptions thereafter. And then if I want to, I can also add any information I've got around fixed assets and any existing debt. So I've got existing debt. Generally, when you're talking to a lender, it'll be we know we had £5,000 existing debt in the business. So I want to tell them who that was with, what balance. So we know it's 5,000. The term it was over, it might have been over 5 years. And we've got left, we know we've got, I don't know, maybe half a year left on it. And then a reason for borrowing there. So now we've got everything within that model now. To put in front of a lender for, we're not talking about a bounce back loan here. We're talking about proper investment, which is required to either drive this business forward or help facilitate a serious short-term deficit in cash. So I've talked for an awful long time. Hopefully everyone understood that. Like we say, if you've got any questions at all, we can cover them off in the chat. So I guess it's back to you, Sean.
Okay, thank you, Mark. Appreciate that. Hopefully that was extremely comprehensive. I'm just going to unmute everybody, and if anyone's got any questions, then just shout them out.
Has this been recorded, Sean?
Yes, John, you'll all get a link to the recording.
It was Graham, actually, but there you go.
Oh, sorry, Graham. Yes, you'll get a link to the recording. Sorry, you didn't pop up. Yes, you will, mate.
Okay, thank you. I'd like to re-look at it again. Yeah.
No problem. Okay. Everybody else happy? Well done, Mark.
Yeah,
obviously
presentation.
Done a good job there. Okay, so just a very quick recap then. So Mark's covered the ability to produce a really, really detailed plan and forecast, so month by month for the next 24 months, and then years 3 to 5, as he says, if you can do monthly on years 3 to 5, then you're a better man than I am. And to be perfectly honest, if you can do it year 2, you're a better man than I can with any degree of certainty. With a specific ability there to support your funding requirements and produce a report that we know from experience lenders love. It's got everything in there that they could possibly want. It shows that you will know and understand your current figures, as well as have a really solid understanding about what's happening within your business and what you want to do with it going forward. So I think this is a really great tool, usefully written into Excel, basically because we all understand Excel. And you will also this afternoon now get a link as part of the feedback to a fantastic cost saving and opportunity analysis tool, which, as I said to you, completely free of charge, is our gift to you as a thank you for coming on the meeting this morning. So you'll get a link within the next couple of hours. Well, as soon as the recording link comes through, we'll make sure that that's sent onto you as well. You'll also get the cost saving and opportunity analysis tool, and I will give you as part of that a code that you need to enter so that you get that free of charge. This is normally commercially available, but you get that without compliments. And we will also send you the base template as well of the tool that Mark's gone through today, so you can literally get off and do what Mark's done today for yourself. So I hope you'll find that that's a fairly generous offer, and I hope that you found that useful and informative today. So if you aren't ahead of your planning and your forecasting, now is a great time to do this. This is a fantastic opportunity that we're giving you to go ahead and make a difference, make a change to your business, provide the funding that's needed, do the business planning that you want to and need to do post-COVID, whatever that may be. And this is absolutely my favourite quote at the moment. You'll see this on all of my presentations. Everyone who's been on one recently is sick of seeing it, but if you wait, what happens? You just get old. Yeah, we just get old. We're all getting older. None of us are getting any younger. So with that, I thank you. Really appreciate you spending the time with us today. We're bang on time, so well done, Mark, again. Appreciate you coming. Hope you found it useful. You will get an email from me later on today. If you've got any feedback, please just ping it back to me on that as a reply to that email. And I look forward to hearing of all your great successes using these tools and resources. So thank you very much, one and all.
Thank you, Sean.
Thanks very much.
Thanks, Sean. Thanks, Mark.
Pleasure.
Cheers.
Thanks, Sean.
Bye-bye.